When you read about blockchain, the first line you will hear is that it's an immutable ledger of data, which is sitting on multiple computers at the same time. But all of that sounds like Greek. So I tend to break it into three pillars. The first pillar is distributed ledger technology. So blockchain is a type of distributed ledger technology. What are we talking about, distributed ledger? So essentially, as we all know, a ledger is just a table of records. Now, it's distributed because it sits on multiple devices at the same time. Now, these ledgers are compiled into blocks of data. And the blocks of data, or each block of data, is verified via a process called either proof of stake or proof of work. That's known as a consensus mechanism, or the consensus mechanism upon which the blockchain works. Now, when a block has been compiled, the different computers within the ledger race to verify the data within that block. A common methodology is to use proof of work. So proof of work is essentially, if we're all familiar with, let's say, calculation like internal rate of return, which when you're working on it manually is very iterative. So you're given a very iterative problem, mathematical problem, that doesn't have a glaring answer. You need to solve and solve and solve all over again. But the beauty of such a problem is that once an answer has been found, it can be very easily verified by everyone. So if we're working on an internal rate of return mechanism and calculation, and we don't have a calculator, as soon as one person finds the answer and supplies it to us, we can all verify that the answer is correct. So that's simply what the proof of work mechanism is. So when a block has been compiled and it's time to validate it, all the computers race to find the answer to that mathematical problem. As soon as it's been found, the first person who finds it gets the right to validate the block, and he gets the reward for validating the block. Within the Bitcoin ecosystem, that is how Bitcoins are created. The reward for finding the answer and then validating the data within a block is actual Bitcoin. Now, the next pillar is nodes. So like we said, it's a distributed ledger, meaning all of this data is sitting on multiple computers at the same time. These computers are called nodes. These nodes form the governance mechanism of the blockchain network. In addition to having all of the data sitting on their computers at the same time, the consensus algorithm or the consensus protocol contains rules, contains agreements, irrefutable agreements, by which the network will be governed for the good of the entire network and users of the network. So within blockchain, you have two broad spectrums in terms of how blockchain networks are structured. You have a permissioned blockchain and you have a permissionless blockchain. So a permissionless blockchain is one where anyone with a strong enough computer can decide to be a part of the network and decide to join the governance system of the network and decide that he's also going to be competing to validate transactions on the network. So it's open to anyone who has the computing power. The permissioned blockchain is a lot more controlled, where there are entry requirements. So you just don't come in because you have a big machine. There are entry requirements, and then even if you're a part of the network, not everyone can actually validate data. Not everyone is eligible to validate data. So essentially, there are permission levels within that framework. And then on the other spectrum, you have public and private. So a private blockchain, take for instance, is NESD can decide he wants to have a blockchain system to do a couple of things. That's a private blockchain. On the other end, you have a public blockchain, like the blockchain which underlines Bitcoin. It's a public blockchain, open to anyone who wants to come in. So that basically covers blockchain. So it's in the world of crypto assets, we start talking about things like Bitcoin, Ethereum, and the more fancy things we hear about, and people making a lot of money. But to really break it down, what's a crypto asset? A crypto asset is simply a token that represents something in a given ecosystem. It could represent a wide variety of things. It could represent value. It could represent ownership stake. It could represent voting rights. The people who build the blockchains decide what the cryptocurrencies they're going to create from that blockchain will represent. So you have three broad types. The first is cryptocurrency, which is Bitcoin. So cryptocurrency is essentially a type of currency which has been created cryptographically. So there's no central authority issuing it. It is created using cryptography, and it is maintained via the interaction of these computers on the blockchain network, which we've discussed. So the purpose is, or the vision behind cryptocurrency is, they set it out to replace, to a very large extent, fiat money. So if you take some steps back, Bitcoin came out in 2009. It came out against the backdrop of the great financial crisis. You had banks crashing. You had a lot of loss of confidence in the financial system as a whole. So you had a lot of these computer scientists pulling out a lot of visions for electronic money from theory and trying to bring it into reality, because they had lost confidence in the entire centralized banking system. So the vision is a decentralized currency issued and controlled by no one, which can be used to make payments for goods and services and make international money transfers. So that's cryptocurrency. On the other hand, you have utility tokens. So utility tokens are what we described. They represent value or stake in a closed ecosystem. So take, for instance, you build a blockchain, and on the blockchain you say, ladies and gentlemen, come and create all sorts of applications on this blockchain. Now, to pay for access to this blockchain, there is this token. This token, payment of this token gives you access to this blockchain. Payment for services and for products created within this blockchain network, you pay using this utility token. Still within the universe of utility tokens, you have people trying to take, for instance, I want to improve engagement with my customers. So I can create a utility token, which I will then sell to them and gives them voting rights to help me co-create products. So, for instance, what's been happening over the last 3-4 months, you have football clubs. Football clubs on mainland Europe, they've created tokens and they're selling to their fans. These tokens give them voting rights. So take, for instance, I want to change my jersey colors. I put it to a vote to fans. Only fans that have tokens can vote. I want to change the in-stadium experience. I want to change where the food stand is. I give that power to my fans to vote. So you find that the utility token gives a lot of flexibility for companies, for businesses, to sort of engage their customers a lot better in ways we couldn't even imagine before. And at the same time, the companies make money. So it's a legitimate way to try and raise some money, and at the same time, create that sort of brand loyalty, because customers like to feel important. So imagine giving fans more control over the experience, or more control over the products which you sell to them. So that's the world of utility tokens. And then security tokens, we would all recognize security tokens. So security tokens are simply digital securities. So you have your equities, you have your bonds, you have your structured products. These are securities which have been created to carry out their functions automatically without any human intervention. So from the instant those securities are created with the computer code, the equity behaves like an equity. It pays dividends without anyone having to do anything. The bond pays the coupon when it's due, and then it redeems when it's due without any human intervention, without anyone tweaking it. That's what security tokens are. So I've provided a brief breakdown of the different types of cryptocurrencies. So like every currency, you have majors. So the majors are the top the top cryptocurrencies that trade the most and have the highest market cap. Market cap being the value of the coins in circulation. So Bitcoin as always is the top, and then you have Ethereum. Ethereum also happens to be a utility token. So the Ethereum blockchain was created less from the point of we want to create decentralized money. It was created as a platform to help people use blockchain to create all sorts of applications to actually transform how markets work, transform how the world works. So the currency to access that blockchain happens to be called also Ethereum. But it became so popular that it grew to become a currency in its own right, and you have merchants accepting it for payments for regular goods and services. And then, so that's it for the majors. Then stable coins. So like I've mentioned, cryptocurrency is extremely volatile. You can't, yes, the vision was to create electronic decentralized money, but like we know, money needs to have certain features for it to be useful. If my money can buy one shoe today and 10 tomorrow, and then none next tomorrow, it's useless money. So stable coins were born from the need to try and create some stability around the price. of these cryptocurrencies, around the value of these cryptocurrencies. So you have different types of stable coins. Stable coins are basically pegged to another asset that has demonstrated stability over time. So you have stable coins that are pegged to currency, that's regular fiat currency, dollar, pound, currently just dollar and pound. And I think there's one pegged to the Mongolian dollar. You have stable coins that are pegged to commodities. So there's one pegged to gold, and there's one pegged to a basket of 7 commodities, 7 metals, which are used in creating electronics. And then you have stable coins that are pegged to other cryptocurrencies. So it's sort of a diversification mechanism, though it's not very good because each of the individual cryptocurrencies are too volatile. Blockchain is useful anywhere people need to keep records and share these records at scale. So it's beyond just financial market. It's just a much smarter and much more efficient way of creating, managing, and sharing data. So it has applications in supply chain, has applications in energy, land registry, and very importantly, in medical information systems. So what are the limitations and some brief proposed solutions? So first, like I mentioned, scalability is very difficult to scale with proof of work. It's extremely difficult. So if we are processing 2,000 transactions per minute now, the technology on ground doesn't let us, the mechanisms on ground don't let us move from 2,000 transactions to 6,000 transactions. Just put it into context, you want to replace money. MasterCard and Visa are processing hundreds of thousands of transactions per second. And the different blockchains, all of them put together, aren't processing up to 100,000 per second. And you want to replace money. That's not going to work. Standardization. There are a lot of blockchains out there, and they're not interoperable. So if I find myself using this blockchain and using services on this blockchain, that is where it sits. So anyone with a different blockchain, I can't do anything anywhere else. So there's no interoperability between them. Then consumer protection. Like I said, it was built from this whole, we don't want control, we don't want authority. So there's no consumer protection. It's the wild, wild west in there. You go in there and anything you see, you take. There's no transparency also. Anonymity is, and that's why you have a lot of people trying to clamp down on cryptocurrency use because they say it's used for money laundering and financing terrorist activity. And then perception. So you pick up a newspaper or even Google cryptocurrency and the first thing you hear is blockchain lost $10,000 in one night. So the perception is very bad. You pick up another newspaper, company runs away with $200 million from ICO. You pick up another newspaper, cryptocurrency exchange crashes, $200 million lost. So the perception is very bad, it's extremely poor. So those are the limitations that will stand in the place of adoption of this powerful technology. So what are the proposed solutions which people have come up with from time to time? So the first one is we need to change the consensus mechanisms we are using. So one solution which the Ethereum founder proposed was that instead of having all the computers race to verify transactions, why can't we do a quorum system? So 2/3 of the computers or half of the computers can verify, one person can solve the problem, half of the computers can verify it, and we say we are good. What that means is you're able to process twice as much transactions because instead of all the computers working on one block, you have half working on one block, half working on that block. And then moving to proof of stake away from proof of work. Second one is embedded supervision. So embedded supervision has been proposed. Raphael is an economist with the Bank of International Settlements, and he's looked at the economic side of how blockchains work. And he's proposed, look, let's do something. Let's embed supervision into the design of this blockchain. But he has picked out a couple of conditions. So first, as a regulator, before you even, because you're taking their word for it, you're taking their word that these transactions happened, but they may not have happened. So you need to, the blockchains which you're going to embed your supervision into need to have a couple of conditions. They need to meet a couple of conditions. First, you need to assure payment finality. You need to ensure that the stake which a miner is putting forward is higher than any bribes which he can be paid to undo the block which he has put forward. So if any data within his block happens to be reversed, he loses that stake, and that stake should be large enough, or should be larger than any bribes he can be paid by any one person with data within that block, or even the entire members of that block. So this would address to a very large extent consumer protection. As a regulator, you've now built your surveillance systems and your supervision systems into the blockchain. It would also address transparency. So as much as you want to keep that anonymity, you have a regulator who has eyes inside the blockchain. Then awareness. So awareness is going to address to a very large extent a lot of perception issues. So first and foremost, awareness as to the risks. So you go there as an investor or as a participant, you go there with two eyes open. We need to create awareness of how it works and what the risks are. So that if there's an ICO, you don't run in when you hear 50% return. You want to find out, like you would do for any equity investment, what are these people building? What is the prospect? What are the future prospects? So awareness as to how it works and then the risks would to a very large extent address people from falling prey to the bad sides. And then awareness to the benefits, very important, because it's going to save everyone a lot of money. And then it's going to be able to give consumers a lot more choice in terms of the products they use and how those products are created and delivered to them. So also creating awareness as to the benefits would also help adoption to a very large extent. So parting gifts. There's a lot more to blockchain than cryptocurrency, like we've covered when we talked about the financial market use cases and the real sector use cases. There's a lot more to blockchain than just cryptocurrency. Blockchain-based delivery of financial services is beginning to crystallize into something called decentralized finance. In the next couple of years, that's a theme that would happen significantly, where you have people providing each other financial services as opposed to financial service firms providing them those services. And then, like we mentioned, blockchain holds potential to transform everything that involves record keeping and data sharing. And then finally, crypto assets, like we described the utility token. It gives us a toolbox, it gives us a means to really change how we deliver services, to really change how we engage our customers, to really change how we even reward our customers. So if I had a hotel, for instance, and I needed to boost occupancy rates, I could decide to issue a token and tell everyone who buys the token that you get 20% off. So what that happens is people are interested in coming to sleep here because there's this token that exists that gives me 20% off just for staying here. So it's a tool that gives you a very different way to look at your business and how you approach serving your customers.